How well informed are you on Tesla stock? Did you know there's a major caution for those thinking about buying Tesla shares? Don't miss out on finding out what it is, so stick around and keep watching. Tesla stock is closely watched by many. In light of the current economic climate, stock market performance updates have investors on the edge of their seats. Investors and analysts alike generate informed forecasts of stock performance and disseminate this information to anyone who is interested through interviews, articles, news, and online posts. In today's video, you'll discover how a Tesla bull delivered a significant warning to Tesla stock investors. Tesla is an American automaker and renewable energy firm headquartered in Austin, Texas. They produce electric vehicles, solar panels, solar roofing materials, and related goods and services. In addition to producing electric automobiles and energy generation and storage systems for sale in the United States and internationally, Tesla Incorporated also designs, develops, produces, leases, and distributes these products. The business is divided into two main divisions: automobiles and power generation and storage. The future is bright for Tesla, and bulls are betting on it. Among other things, bulls are purchasing because of the likelihood of a future robot taxi network operated by Tesla, a movement in the preference from ICEs to EVs, expansion in the Chinese market, and the simple fact that they think Tesla creates a terrific automobile, a confirmed Tesla bull. Morgan Stanley issued a stern warning to those who had invested in Tesla stock. Morgan Stanley is a New York City-based subsidiary of the American multinational investment management and financial services firm J.P. Morgan Chase & Co. Morgan Stanley is a global financial services firm that mobilizes cash on behalf of its clients to meet their financial objectives. Additionally, Morgan Stanley employs over 60,000 individuals across the globe, making it a preeminent investment bank and wealth management organization. Investment management, wealth management, and institutional securities are the three primary cash cows for the firm. According to a new report from Morgan Stanley, the Great American Onshore Battery Capex Cycle, MAC for short, will be led by Tesla and represent the mother of all Capex cycles. Tesla's importance in expanding the renewable energy infrastructure in the United States and Western Europe, according to Morgan Stanley, is greatly underestimated. They believe that conflict and inflation will lead to new forms of energy production. Inflation has a solid hold on global markets. Inflation is a potent driver for innovation rivaled by conflict, the lack of energy supply, both structural and idiosyncratic, renewable and fossil ranks high among global issues. Morgan Stanley estimates that between $10 and $20 trillion in cumulative capex spending is needed from now until 2040 to re-architect the global renewable energy infrastructure and supply chain. Investing in companies that benefit from this capex cycle can provide significant alpha. Heavy industrial brands that create stuff, move stuff, and dig stuff out of the ground may be on the cusp of a revival thanks to Tesla, which might revive the old economy that has fallen out of favor. A lot of people have the opinion that features like artificial intelligence, autonomy, and electric vehicles are overvalued. They also underscored their opinion that Tesla's more gritty skills in terms of manufacturing, material sourcing, supply chain, and infrastructure will drive the next leg of growth in the tail. Morgan Stanley's claim that Tesla has reached artificial intelligence capacity may raise eyebrows or dissatisfy others. Even still, Tesla's technological superiority is well known. It's perhaps arguable that Tesla is still the most successful EV manufacturer today. Morgan Stanley, however, revised downward their volume projection for 2022 from 1.46 million units to 1.43 million. This is understandable, given that the Shanghai facility had to temporarily shut down due to COVID-19, but Tesla has been working hard to make up for lost time. The auto assembly plants in Austin and Berlin only recently opened and began producing vehicles. When accounting for zero-emission vehicle credits, Morgan Stanley's gross margin for 2022 dropped from 28.1% to 26.8%. They claim that the decline is a result of inflationary pressure eating into their margins for the rest of this year. They also predict price hikes from Tesla's battery cell suppliers that were not completely reflected in Q1 earnings due to scheduling differences. It's worth noting that Morgan Stanley is making these projections, and it's possible that Tesla shares won't perform as expected. These projections for the flow of funds. According to Morgan Stanley's projections, Tesla's free cash flow will be over $9 billion this year and $27 billion in 2025. Please hit the like and subscribe buttons and the bell notification so you can stay up to date on our videos before we continue. Morgan Stanley's recent bullishness can be traced back to the uncertainty surrounding future price swings. We anticipate Tesla to engage in market trading in the coming weeks and months, and there are certain areas in which we hope market expectations are decreased. Naturally, they gave proof for this claim. First, they believe that the current level of the core automotive margin is too high and does not adequately represent input cost inflation. Second, they think it's unrealistic to anticipate full autonomy, or FSD, to translate into a significant margin boost in the near future. They predict that widespread Level 4 and Level 5 autonomy will be at least 10 years away. They continue to believe that Tesla's future in China is extremely bleak and have not wavered from this position. They think it's possible, albeit arduous, for Tesla to maintain control over some part of a Chinese-run Tesla subsidiary. While our 3,300 price prediction remains unaltered, they elaborated on the changes they made to the valuation model and noted that the model's composition had altered significantly. At $608 per share, down from $646 per share, and at $338 per share, down from $3.93 per share, are the new valuations for core automotive and network services, respectively. To counteract these decreases, we raised both Tesla Energy and Tesla third-party battery prices to $111 per share and $131 per share, respectively. The rising risk-free rate necessitated an increase in our WACC, weighted average cost of capital, from 8% to 8.5%, which had a negative impact of almost $120 per share across all segments. Again, these are merely Morgan Stanley's projections and cautions. It is up to you to decide how seriously to take them. Morgan Stanley, in fact, does and attempts to conduct business with firms covered in Morgan Stanley research, as noted in a footnote on the study page we just discussed. Therefore, investors should be aware that Morgan Stanley research may lack objectivity due to a conflict of interest. When making a financial investment, investors shouldn't rely solely on the findings of Morgan Stanley's study. According to Adam Jonas, the company has successfully entered the market for electric vehicles, EVs. At Morgan Stanley, Adam Jonas is in charge of the automobile and ride-sharing research teams worldwide. He characterized the current state of the electric vehicle market as a race and claimed that Tesla was in first place. "Think of the EV race as a marathon," he wrote. "At the 21st mile, Tesla has taken the lead. Everyone else has either reached mile 2 or is still lacing their shoes." Jonas claims that Tesla will gain ground as the race goes on because it has recently set a record for vehicle deliveries. He increased his price forecast for the automaker's stock this year from $1,200 to $1,300 and projected 2 million deliveries by 2022. Last year, Tesla delivered 936,000 vehicles, and this year they hope to boost that number by 50%. While opinions on Tesla's current stock price from analysts and investors vary, many still hold the bullish view that the company's shares are a smart long-term investment. Nevertheless, you should weigh these forecasts from a reputable financial services firm against your own risk tolerance before deciding whether or not to buy Tesla stock. Even if you are already a shareholder in Tesla, you need to carefully consider whether or not to maintain your investment. These are, once more, merely speculations, and you are of course free to perform your own extensive research. In the end, it's your own money on the line whenever you decide to sell or invest. According to CNN Business, the Tesla stock price prognosis is offered as the 36 analysts offering 12-month price forecast for Tesla Inc. have a median goal of $1,000, with a high estimate of $1,620 and a low estimate of $250. From the previous price of $703.54, the consensus projection is a 4,214% rise. In addition, among the 43 experts questioned, there is widespread agreement that Tesla Incorporated stock is currently a buy. Since May, when it was last updated, this rating has remained stable at buy. Keep in mind that there is potential for great gain with stock market investing, but also great risk. Keep in mind that investing money in stocks is risky from the get-go. It is crucial that you research the market and the stocks you are considering. Visit our channel and view our other videos if you enjoyed this one.